Hello everyone. After studying about the basics of a stock market operation, we will be getting to know the reasons for investing in a stock market and where to start investing in a stock market. Talking about the reasons for investing in stock market, we will be seeing that in a stock market we are getting a better return than other instruments like FDs, RDs and government securities. By investing in a stock market or by buying the company's stocks, we will also be investing in country's better future. We will be seeing how we are doing that. And last but not least, we will be having sense of owning or doing a business without actually being involved in it. Now, where to start? We will be getting to see that where we can buy or sell securities, like the platforms for buying or selling of securities, and choosing of stock markets for investment, and we will be seeing what stocks can be used for by beginners. Moving ahead, let's do the comparison of FDs, RDs and government securities with the mutual funds and stocks. First of all, going through the FD interest rates provided by different financial institutions. Here we have Bajaj Finance, ICICI Home Finance and PNB Housing Finance. These are non-banking financial institutions, non-banking financial companies, which are giving an fixed deposit interest rate at around of 6.10 to 6.6% interest rate. For senior citizens, these interest rates are slightly higher. Now we can see that the banking institutions are giving slightly lower interest rate of 5.85 to 6.25, and in this COVID pandemic, these interest rates have dropped drastically. Like SBI is giving interest rate in the range of 2.9 to 5.4% interest rate. So these drastic drop in the FDs have led to serious blow to your savings where you would have invested in your FD interest rate, where inflation, if it is at around 6% of interest rate, and if you are earning let's say 4% of money through FD, still you are not able to beat the inflation and you will end up having less money than what you are having now. We can learn through an example like what inflation is costing us. Let's suppose you have an apple. Now this apple can be bought at rupees 100 and now you do not want that apple. So you save your 100 rupees in FD where you foresee that after 1 year you will buy this apple at whatever cost it has. Now in FD after 1 year you will be having rupees 104. However, the inflation will lead to the rise of price in apple, which can go to 106, taking 6% inflation rate. Now after 1 year you are having only 104 rupees to buy the apple. However, inflation cost led to the increase in apple price of 106. So you are 2 rupees short. So this will happen when you will save in fixed deposit interest rate, where you will not be able to beat the inflation market, and hence you should look for other better investment opportunities. Moving ahead, here we have the RD interest rate. As you can see here, the RD interest rate are at around 6% for different banking institutions and non-banking institutions. Moving ahead, now let's see here. If we take a comparison of investing in FD and RD, let's suppose a person invested 24,000 of principal amount in FD, for which the interest rate was 8.5% and a tenure of 2 years. Now after 2 years you will get a maturity amount of 28,430 rupees. So the accumulated interest rate will be 4,430 rupees. Similarly in RD, if you are choosing to invest rupees 1000 every month, at an interest rate of 8.5%, you will only be earning rupees 2245 rupees. Now, one more thing to keep in mind is this interest rate is accumulated without any work, and this interest will be counted as your income. So if you are earning, let's say 5 lakh rupees per annum, so this interest rate will be added to your income and you will have to pay tax on this income. Also, there are inflation constraint where you have to beat the inflation by increasing your investment at a higher rate than what inflation is there. Now let's see here. We have certain bonds for which the interest rate is shown as 5%. These are the coupon rate. When you will find the yields, the yield may come to be around 7 to 9%. These are for those which are government securities or bonds. So in a way you can say that you may get slightly higher interest rate than what FDs and RDs are offering. However, these are traditional investment opportunities which are being suggested by our parents and forefathers. But let's face the fact that inflation have risen to a great extent. However, RBI is mandated to keep the inflation in the range of 2% to 6%. Still, due to some constraint, you may get lower interest value than what inflation is. Moving ahead, here I am trying to show you certain corporate bonds which are giving an yield of around 13.4%, 12% or 10 to 11%. However, these are corporate bonds and they also have certain ratings where they can default also, but still based on their ratings you can trust them and manage to earn an yield of 13 to 12, or you can say you can earn an yield of around 10 to 13%. These are way better than what FDs and RDs are providing to you. So you can have this option for investment also. However, there are certain minimum investment criteria to be invested. So this you have to take in mind, where you will need to invest a larger sum of amount than what you are investing in FD or RD. As you can see here, there are certain mutual funds. These mutual funds are providing an annual interest rate, an annual yield of 18 to, you can see here, the annual yield is being provided from 10.33 decimal to 18.67% interest rate. Even if you increase the time horizon to 3 years, still you are beating the inflation by earning an interest rate of around 11 to 14%. These are slightly comparable to what the corporate bonds are providing. However, these are considered more safe bets than corporate bond, because you are investing large sum of money in corporate bonds, whereas you can invest a small amount of, let's say, 5,000 rupees in this mutual funds, or you can start an SIP with an amount of 500 or 1000 rupees in these mutual funds. So you will not be investing a large sum or large amount. Hence, these are considered more better than corporate bonds for small investors. However, large investors do invest in these corporate bonds. Moving ahead. Now coming to the stocks which I was talking about, let's take an example of this Indiabulls Housing Finance or Oil India Limited Power Finance. These are certain companies which are giving regular dividend, and if you see the 5-year dividend yield, these are like 14%, 15%, and even the government company like Indian Oil Corporation, IOC, it is also giving a dividend yield of around 13%. So what this dividend yield is? Let's suppose you have invested 10,000 rupees. After investing 10,000 rupees in Indian Oil Corporation, 5 years back, on an average you will be getting rupees 1200 per year as dividend. Whatever the share price of IOCL be, you will be getting around 1200 rupees per year dividend. And let's say if the share price rises to 20,000 rupees in 5 years, you will get the appreciation of this share price. However, this dividend will remain intact. So as you can see, even after the fall and rise of share prices, you are still getting a handsome dividend amount in your account. So these can be considered as safe bets where you are earning slightly higher income than what is being provided through FD and RD. Now I have taken an example of certain index which are providing different interest rate at a different period of time. Now taking an example of Nifty, which is a group of 50 companies by NSE. As you can see here, in 1 year it has given a return of around 12.56%. In 2 years the return is around 30%. In 3 years it is around 31%. 4 years it is around 72%. So what we can see from here is, even if you divide 4 by 72, you will still get around 18% on an average increment. So what I am telling you is that even if you are investing in this kind of index fund, still you will be getting slightly higher income than what you will be getting through FD and RD. As you can see here, the IT sector is booming in India, which is giving a return of around 138% even, and if you will divide it by the number of years, on an average you will be getting an interest of around 25% or more. Now this interest you will not get in any kind of other instrument. Now let's see what is the role of investment in country's future. Now taking an example at your home only, if you do not have money of, let's say, 1000 rupees to buy whatever item or leisure item you want, so you will postpone your plan. Let's say if you want to visit certain place, or if you want to buy a gaming console, or even if you want to buy a certain mobile or laptop, you will be extending your plan and you will be waiting to get this spare 1000 or 10,000 rupees to buy. Now when you will have this money, you will be going you'll go to shop and buy all these items, and in this way you will be putting the money in the market. Now what will happen if you will not put this money in the market? See, with the lack of money in the market, the businesses will stop, the economy will fall down, and there will not be any kind of growth in the economy. So lack of cash will lead to lack of transaction, and lack of transaction will lead to lack of business, which will lead to lack of employment. Persons will not be employed in other shops or whatever business you are providing them, which will lead to unstable economy. Now the poor influx of FDI will happen if the economy is unstable, because foreign investor will not be looking to invest in country where the economy is unstable. You can take example of countries like Horn of Africa, where the economy is very unstable. So people do not invest in those countries. However, India is considered as a safe bet to invest by foreign investors. So this vicious cycle will continue to grow, and this will lead to decline of economy. Now if we put more money in the market, this vicious cycle can be broken, and hence our economy will grow. Taking another example, let's see here. This is a data taken by IMF Statistics in 2017 yearbook. Here we can see that China is investing 45% of its GDP. Now, this investment has led to rise of GDP by 136%. Similarly, Korea is investing 29% of its GDP. Now, as you can see, with the rise in investment, the growth in GDP is rising. There are certain other factors also which led to rise in GDP, but this increase in investment cannot be outlooked, or you cannot ignore these investment. Whenever you will see an economy growing, you will see that people are investing more and more in their economy, which will lead to their growth. As you can see here, with the less investment, the economy growth is less, and with the higher investment, the economy growth is much higher. Moving ahead, now the sense of owning the business. Now, when you see these products like Hawkins, Bata, and when you go to DMart for buying whatever items you need for your home. Now, when you see this Tata Consultancy Services, it is very favorite of students in IT sector, Infosys. When you try to buy a car like Maruti Suzuki, you are paying huge sum of amount for Maruti, and you will be buying these products. But what if you own these products? What if you can say that this Bata is owned by me? Like if you are owning the business of DMart, you are owning the business of Infosys. So whatever profit or whatever revenue these companies generate will be shared by you. So this sense of owning a business without actually being involved in it is great for all the investors. Moving ahead. Now, we have to know that where we can buy these businesses, that is where we can buy these securities so that we can share a part of its business. We have certain brokerages houses. There are two types of brokerage houses. One is discounted broker and the other is non-discounted, or these brokers give you suggestions, they give you detailed analysis, and some of them also give you relationship manager who advises you that in which stocks or securities you should be investing your money. Now, these discounted brokers do not give you any kind of suggestion or advice. They only facilitate you in trading. So, as we can see here, like Zerodha, Angel Broking, and some other brokerage houses like Upstock, they are certain kind of discounted brokers. However, ICICI Securities have also ventured into this discount broking platform. So, what I am telling you is, based on what kind of brokerage house you want, you can open your account in any of them, where you can take their advice to invest in the stock market, or you can do your own research and select the companies by your own and select the discounted brokers where you can save a lot of money and invest in whatever company you want with the discount broker of your choice. In India, the most used discount broker is by Zerodha or Upstock, where people choose them just because of the less price they have to pay for investing their money. However, you can also choose these brokerage houses where they provide certain suggestions, or they give you a relationship manager for your investment. Moving ahead. Now, what stocks a beginner should choose and how they should be choosing it. Here I have given certain examples of large cap companies, mid cap companies, small cap companies. Now, based on these companies, if you are a beginner investment, you should be getting to know about the company product. You should be analyzing that whether this product is useful or not, whether you are understanding the company's business or not, whether the company has sustained for a certain period of time, say 5 years, 10 years, depends on your analysis, or if the company's governance is good or not. If you are having certain understanding of the company, that how this company is earning its business, or how this company is gaining its profit, it will help you in better analyzing the company and investing in that company. The future prospects can be understood by daily following the news or understanding the market scenario, or you can read the annual performance report where you can find what the company growth is there on a year-on-year basis. Every company declares its result on a quarterly basis, so you can get the quarterly result, half-yearly result for the company and analyze that is the company making profit on a regular basis. So from where this information can be gained? Now I have got to know two sources which I prefer. Now let me show you them. After getting to know, after checking the different sources for getting to know the information about different companies, I have seen that these two sources are very much useful in deciding where and how we can invest in certain companies. Now let's say we want to invest in Infosys. So how and what data we can look forward for the investment opportunities? Searching for Infosys. Now as you can see, there are certain updates here. In this update, you can see that whatever the company is giving information to NSE, it is being updated here on a regular basis. So you can see here, the news are being updated from the markets here. Whatever announcement is being made by company based on its share or whatever dividend or quarterly result it is giving, as you can see here, the financial result for Q3 financial year 2021, the board meetings and all, you can see here. These are only for analysis purpose. These are corporate actions, that in what year, what dividend it has given. As you can see, it is giving a dividend on a regular basis. So you can consider this company as good and you can invest in this company. Now let's see the technical analysis. As you can see, on a 5-year growth, this company has doubled whatever share price it had 5 years ago, instead of giving dividends also. Now checking its fundamental prices, as you can see here, there are certain things which you need to consider for investment. So one of them is earning per share. These are terms which we will be discussing in our further videos, that what these terms mean. However, if you want to gain a certain understanding of these terms, you can get these understandings here also. Now we will be discussing about these earning per share or price to earning ratio. On a broad basis, I can tell you that this price to earning ratio tells you that how much expensive the company is. As you can see, the industry PE is 30. So you can say that whatever IT companies are there, they are 30 times more expensive than their base value. And this Infosys is slightly lesser expensive than their peers. As you can see, the book value per share is 166. So it is being traded at 7.6 times whatever book value it has. It is giving a dividend yield of around 1.37% on an annual basis. Now let's see the result. As you can see, we have the quarterly result. You can see here that the profit after tax or the net profit is rising continuously on a quarterly basis. So you can say that this company is giving consistent result in its past. So you can trust what business model it has. Now coming to the ratios. Now this I consider important while investing. As you can see here, we have a return on capital employed, return on asset, return on equity. We can discuss these terms in a greater manner, or you can find what these terms means in these videos, as you can see here to my right. Now As you can see, the return on capital employed or return on asset is very high in these companies. Like if you are getting 5 to 6% interest on an FD or RD, you are getting a return of 30, 32 to 34% on whatever capital you have employed or whatever assets you have. Still, you are gaining an return of 20%. So this is considered by me as good company to invest. You can search for all other companies for investing. That's it. Thank you very much.